I'm Jenn Swartz with Treeline Realty, and today I'm meeting with Senior Loan Officer from Cross Country Mortgage, Matt Pell. Thank you so much for being here.
Thank you for
Appreciate it.
having me.
Awesome. So we're going to dive right into lending because I know there are a lot of people out there that have so many questions. So
Absolutely.
let's start by talking a little bit about what a pre-qualification is and a pre-approval are, the differences between them.
Yeah, that's a very important question because there's a lot of times people will come to me and they just want something now to be able to start shopping around.
Mhm.
And usually what happens is if you need something literally spit out really quickly,
Mhm.
lenders will give you what's called a pre-qualification.
Okay.
And that's really, to be honest with you, it's not even worth the paper it's written on because they're doing is they're just pulling a credit report. They're taking the income that the borrower is stating that they make and the assets that they're stating that they're making, and they're just out of good faith giving you a letter. A pre-approval is much more in depth. You're doing an actual full credit, income, and asset analysis. It's going through a pre-underwrite. So when you go shopping, you can feel very confident that the borrower has had their due diligence done on the front end. And that usually then will allow the process to go much more smoother as you actually get under contract and go through the home buying process.
Okay, great. So, and talking a little bit more about that, can you explain what is DTI?
So DTI is an acronym for debt to income ratio. So again, it kind of goes back to getting officially pre-approved because if you've actually done a full income analysis and have obtained the tax returns and the pay stubs and all the things that will be required once the loan goes into underwriting, then you can actually determine what your proper debt to income ratio is to make sure that it conforms to what guidelines will allow.
Perfect. So, and going on that a little bit further, how is it calculated?
So there's two types of ratios that lenders consider. One's called a front end debt to income ratio, which is basically the total cost of the housing expense. So that would include your principal and interest payment, property taxes, homeowners insurance, even HOA fees. Okay,
Mhm.
if you're purchasing in an HOA, then you have a back end debt to income ratio, which is your whole housing expense plus everything off the credit report. So again, that's why it's important to make sure that you don't get in a situation where that debt to income ratio exceeds what guidelines allow for both front end and debt to income and back end debt to income ratios.
Some great information. Um, of course, there are all kinds of different loans out there. One of the most common ones being a conventional loan. What is a conventional loan?
So a conventional loan is typically one that is for a more credit-worthy borrower. Okay, it's backed by government agencies, Fannie Mae and Freddie Mac. And those are considered to be conforming loans. Okay, a lot of times people have a misconception that they have to put 20% down in order to get a conventional loan. That is not true. You could put as little as 5% down if you wanted to. Okay, it will trigger that you have mortgage insurance, what's called PMI, private mortgage insurance, and but then that will fall off once you get to a 20% equity position. If it does not conform to the Fannie Mae and Freddie Mac guidelines, then you would not be it'd be considered a non-qualified mortgage, meaning it would not be a conventional loan, and therefore it would not be a purchasable loan in the secondary market through Fannie and Freddie.
Okay, good to know. And then what is an FHA loan?
So FHA is actually a government insured loan through the Federal Housing Administration. This loan is typically for maybe lesser creditworthy borrowers. Maybe they don't have as good of a credit score. Maybe they have just the bare minimum, put like 3.5% down. There's actually a misconception that first time home buyers need to be an go with FHA. That is not true at all. If you have a good credit score, you can easily go with a conventional loan. But FHA is actually a very good loan. depending on the circumstances of the borrower. It does come with mortgage insurance. Instead of called PMI, it's actually called MIP, which is a mortgage insurance premium. The downfall of FHA is you actually are stuck with that mortgage insurance for the life of the loan. So typically, it's a good loan to kind of get your foot in the door for purchasing. But then when a refinance opportunity comes available, typically you'd want to refinance out and get into a conventional loan.
Okay. And what about a VA loan? What is that?
So VA is another very good loan. It's instead of a government insured loan, it's a government guaranteed loan, and that's going to be through the Veteran Affairs. So it is for military personnel who are eligible. The benefit of a VA loan is it allows you to put no money down.
Mhm.
The not so good the benefit is, well, it doesn't carry mortgage insurance like an FHA loan or a conventional loan would. It does come with a funding fee
Okay.
that you would pay upfront that's financed into the loan amount. So, there's no such thing as a free lunch in life, right?
Is that it? Okay, so the burning question. Let's talk a little bit about rates.
Yes.
How are mortgage rates influenced?
So there is a lot of misunderstanding on how mortgage rates are determined. So uh, a lot of people think that, well, the federal funds rate, right, which is
Mhm.
the what the Fed manipulates through their monetary policies. They just recently dropped 50 basis points, which equates to a half a percentage point. So then people call me up and like, oh, rates just dropped a half a percent. Well, no, that's for short-term debt. So that influences credit cards, car loans, student loans, things like that. Mortgages are they're long-term debts, 30-year securities, right? So what you have to do is you actually have to watch how those securities are traded through what's called the mortgage-backed security markets, the MBS market, which is a bond market. So as stocks and bonds trade differently throughout the
Mhm.
day, the trading of those bonds and the pricing behind those bonds influence what mortgage rates do. So a lot of times mortgage rates and the pricing of those rates are priced into the market well in advance before the feds actually cut rates, the federal funds rate. So it's kind of an important thing to understand actually how it all works, because it's not always so cut and dry. And there's a lot of influences, inflation, things like that, that drive the expectations of how these bonds are going to be affected.
Okay. That's a lot of good information. I know there's a lot of people out there that definitely have some misconceptions about interest rates and
Right.
how they work. What is a yield curve?
Yield curve. Yeah.
This is
So
something that's out of my element.
yes, yes, yes. So we're kind of getting past the
Yeah,
mortgage 101 here,
that's
right? Right,
right.
right.
And
But in general, think of a yield curve like a line graph.
okay.
Okay. So what it's doing is it's reflecting the rate of return. Okay. So if you over a maturity time, a period. Okay.
Mhm.
So if you can kind of put this in perspective here, if you were to invest a certain amount of money over a certain period of time,
Mhm.
the longer that investment would be, the more of a return that you would expect to receive, right?
Okay.
So the higher rate of return, the higher yield you would get over that maturity period.
Okay.
Okay. Now, that yield curve generally stays in a straight line, but there are times where it will become inverted.
Oh.
Okay. So what that means is basically the longer you stretch it out, the lesser of a rate that you would actually get. So this actually can be seen recently if you were to shop around for any type of CD. Okay. For instance, let's say that you want a 12-month CD,
Mhm.
and that CD was at 5%. But then you said, okay, well, what if I went with a 24-month CD? Well, that CD is only at 4.5%. And you would say, well, why? I'm tying up that money for a longer period of time. You would expect that you would receive a higher rate of return
Right.
because that money is tied up over a long period of time. But during seasons of that curve being inverted, then that actually means that you would be getting lesser of a return the longer that you invest that money. So obviously that can be troublesome, right? It's not typically a situation that you'd want to be in with an inverted yield curve. But just recently, since the Feds did lower the federal funds rate by 50 basis points, that yield curve is actually re-straightened back out, and we're seeing it to be corrected again.
That's good to hear, definitely. So, can you talk to me a little bit about closing costs? I know this is a big question for home buyers because they don't quite understand what makes those up.
Right. So that can be a little confusing at times. Closing costs is basically the entire cost to do the transaction. So it's not just your lender fees. Okay. Closing costs and company, your title fees, your appraisal fees, the tax in Florida, we have a state tax on the transaction. Because we don't have an income tax, so that's the way that Florida generates revenue is off of real estate transactions through a mortgage tax. You might have capital contribution fees with an HOA. You're going to have all your prepaids. So for homeowners insurance and property taxes, basically the total cost of everything involved to do the transaction is kind of under the umbrella of what closing costs are. Okay. Now, within those closing costs, you do have your lender fees, and those fees can vary depending on what interest rate you choose. So it's always important to understand there's a direct relationship between what rates are
Right.
and what your fees are. So as interest rates go up, your fees will actually go down because you'll pay less for that rate. In fact, you could even choose it, maybe even get a credit if you chose a high enough rate. If you wanted to get a very low rate, like a teaser rate, a lot of lenders will play that game. Then you're actually going to pay points. So what you're doing is you're buying that rate down. So there's a direct relationship between cost and rate. So what I usually advise my clients is I kind of price it out like a bell curve, right? There's a diminishing marginal return as you go, the further you go. So you kind of want to be in that sweet spot where you're paying as little to no cost for that rate as possible,
Mhm.
while still getting the lowest interest rate possible, knowing that chances are at some point the market will improve as it's projected to as rates continue to go down, and you might be able to refinance and get that better rate without having to pay the fees down the road.
Okay. And talk to me a little bit about the lending process. How long does that typically take?
Well, that's a really good question. Actually, that's going to circle back around to our very first question. Okay. And that's the difference between getting a pre qualification and a pre approval.
Right.
Right. So it is, if you go through the actual pre approval process and you do your due diligence on the front end, you're going to have a lot easier time for that for a smooth transaction to go through underwriting. So we at Cross Country Mortgage actually have a 21-day closing platform because we like to do our due diligence up front without having to wait until you get to the back end of the transaction. Most lenders can close loans within 30 to 45 days, but we can definitely close loans much sooner than that because of the way that we approach each transaction.
Awesome. Well, thank you so much for taking the time to speak with me. And if you have any questions regarding lending, feel free to reach out to Matt Pell at Cross Country Mortgage.
Thank you so much. Appreciate you having me.